Good afternoon, class. Welcome to this session of Strategic Financial Management. In our last class, we were discussing regarding NI approach or net income approach. In that, I had given 3 of the sums to be worked by self. As a matter of the fact, only 14 of you have given the or submitted the homework, and even in that only 2 of you had completed the 5th problem. So let us just check what is the correct answer for all the 3 of the questions. Now the third question is all about X company limited is expecting an annual EBIT of rupees 1 lakh. The company has rupees 4 lakh in 10% debentures. The cost of equity is 12.5%, and you have been asked to calculate the total value of the firm and the overall cost of the capital. That would make up the first scenario, and they have given still more information regarding you will have to calculate when the situation is such that the company decides to raise rupees 1 lakh by issuing 10% debentures and uses the proceeds from the issue to redeem equity shares. And in another situation, the company decides to redeem debentures of rupees 1 lakh by using equity shares of 1 lakh. Now, for that particular question, the solution would be as follows. Now, this particular solution had been completed by Sabina. The same thing I have put it here. So, according to the question, the valuation and the cost of capital under net income approach would be as follows for 3 different situations. So, the EBIT they have given it to be 1 lakh, and it stands same for all the 3 different situations. Once you have earning before interest and tax, you will have to decrease, you will have to deduct the interest if any. So, the interest rate they have given at 10%. For situation A, there is no any such condition. So, the interest would be 10% on the current debt of the company. The current debt stands at 4 lakh. The current debt stands at 4 lakh. And for situation B, they have given specifically that there is going to be an increase in the debt for an amount of 1 lakh, and thereby the total value of the debt has been increased to 5 lakh. And for situation C, they have given the information that there would be redemption of debentures to an extent of 1 lakh. And once after the redemption, the total value of the debt stands at 3 lakh. Now, interest has been specifically given, that would be at 10% on debt. So, for each of the situation, when you put 10% on the debt, it stands at 40, 50 and 30,000 respectively for situation A, B and C. Now, since the assumption is such that there is no any corporate tax, the EBT or earnings before tax itself becomes net income available to shareholders. So, under each of the situation, after deducting interest, the net income available would be 60, 50 and 70,000 respectively for situation A, B and C. Now, that you know the net income available, from the information we can calculate the total value of equity shares, and they have given the cost of equity to be standing at 12.5%. We have to take 12.5 divided by 100, it would be 0.125. So, the net income you do know for different situations, that would be 60, 50 and 70. So, 60,000 divided by 0.125 would give 4,80,000, and 50,000 divided by 0.125 will give you 4 lakh, and 70,000 divided by 0.125 will give you 5,60,000. Now, the debt value here has already been calculated to be at 4 lakh, 5 and 3 lakh. So, while calculating the value of the firm, you will have to add the total value of equity and the total value of debt. So, the value of the firms stands at 8,80,000, 9 lakh and 8,60,000 respectively for situation A, B and C. Now, speaking regarding overall cost of capital, we can calculate it by dividing earning before tax by value of the firm and multiplied by 100. So, the overall cost of capital stands at 11.36%, 11.11% and 11.63% respectively for situation A, B and C. Hope you all have solved this. Now, accordingly you will have to give both the working note and conclusion for the problem. Now, these three were the problems taken by textbook. The fourth question and the fifth question were respectively asked for your examinations. Okay. Now, the fourth question is of Mahima Limited, and it has net operating income of 30 million and it has a debt of 100 million which carries 10% of interest. The equity capitalization rate stands at 15% and you have been asked to calculate the market value of the firm under net income method, and you have been asked to assume that there are no any corporate tax. Okay. Even before we start with the problem, you will have to know the difference between the Indian numerical system and English numerical system, because when you have to convert from million to rupees in any of the cases, okay, it would be helpful. Some of you, while working out the problem, you were very smart enough wherein you have taken 10 million divided by whatever you have to take. That is also fine, but numbers will give you the accurate information. So, now what has been displayed in the left hand side is Indian numerical system, and whatever has been displayed in right hand side is English numerical system. See, up until 5 numerical places, it is the same. It is ones, tens, hundreds, thousands and 10,000s. The difference starts from the 6th digit. Okay. In Indian, whenever it is 6 digits, it is 1 lakh. But when it comes to English numerical system, it becomes 100,000. Okay. And the 7th digit here under Indian numerical system is 10 lakhs, and in English numerical it becomes million. So this is what I said other day. 1 million is equal to 10 lakh. If you know that, it would be easier. Okay. And always remember that for 10 lakhs there should be 6 zeros, or for 1 million there should be 6 zeros. And 10 crore would be 10 million, and 1 crore would be 10 million, and 10 crores would be 100 millions. When it comes for your strategic management, if you know up until this point, it would be very much helpful. And even when you are putting your commas for the numbers or the values, see the changes here. Under Indian numerical system, the first would be put after 3 digits, okay, after the 100. Okay. Here for the 1000, the first comma would be put. The second would be put after, once again after 2 digits, and the second one once again after 2 digits. So 10 lakh would be having in total 7 numbers with 2 commas. Okay. But here it would be, there would be no any changes. It would be for 3 numbers each. So even when you put that, you should be very careful, because nobody would be counting how many zeros you have put. Based on what commas you have put, they would directly calculate it. So remember one thing, 1 million is equal to 10 lakh, and in English numerical system you will be having million, 10 million and 100 million. After 10 lakh in Indian numerical system comes crores and 10 crores. If you know so much without any confusion, that is to tell, this is the simple thing we all know, but we all do get confused. So if you know this simple 9 digits, it would be very much helpful in all your practical papers. If at all they give in millions, if you are comfortable enough, calculate in millions itself. If you feel it is confusing, convert into your lakhs and then continue. Okay. Whatever is easy for you, you can do it, but then there shouldn't be any kind of changes, that you do step 1 in certain kind and step 2 in a different kind. Whatever you follow, entire problem follow the same thing. Now going further, this is how it looks. We have thousands, after that lakhs, crores, comes Arab, Kharab, Nil, Padma, Shank and Mahashank it is called as. In the international system it would be hundreds, thousands, millions, billions, trillions, quadrillion and up till quintillion it is there. Now so much is not necessary. Up till 10 crores if you know, it is more than enough, but up till here you should know correctly. to the power of 8. That is up until the point where you put 8 zeros, you should know in both the system. Okay. Now we were speaking regarding the Mahima Limited company. Now this particular problem, almost 14 of you who had sent the answer, you have done it. Okay. Okay. Now see here. Here what has happened is, here you have maintained 3, 3 and 2. Here you have forgot to put the commas. So that's what I was telling. Okay. If you are now here there is no any number, so there is a bit confusion. So if you are maintaining, it is maintain the same thing whatever you had maintained earlier. Okay. So how much would be this according to this? It's hundreds, thousands. After thousands comes in English numerical system millions. So this would stand at 133 million. Okay. So according to the problem, the net operating income would be 30 million and the interest rate would be 10% on 100 million of debt. So it would come up till 20 million. So once after deducting the interest, the net income before tax stands at 20 million. And since there is no tax to be paid according to the assumptions, the net income before tax itself is considered as net income available for equity shareholders. And once after we find that, we have cost of equity, which is 15% or 0.15. Now total market value of equity is calculated by dividing net income from cost of equity. So 20 million divided by 0.15 stands at 133 million 333,000 and 333 rupees 0.33. So the total market value of debt has been given directly. It stands at 100 million. So the entire value of the firm would be the addition of total market value of equity shares and total market value of debt, which stands at 233,333.33 rupees. So the overall cost of capital is EBIT divided by V, which is 30 million divided by 233 million, which stands at 12.86%. Remember one thing, when you have to find out overall cost of capital in percentage, you will not mention in the formula into 100, but whenever you calculate to get this particular thing which has to be represented in percentage, for the formula you will have to multiply it with 100. Okay. Here there are no such things because you are representing it in terms of rupees. Okay. But here into 100 is multiplied because we will have to represent it in terms of percentage. Now all these things are very simple. It looks silly might be right now, but when you solve it for your internals or examination without your books, these are the small things in which you do mistakes, and over the years everybody has done it. So, for right now it might look very simple, but be careful about all those things. So, I hope you have learned how you will represent the numerical system. So, before anything, learn it. Okay. Now, this particular question is also one of the question paper problems. Okay. Now, the information has been given for two companies, wherein they have specifically mentioned regarding net operating income to be standing at. See how they have represented it. It has been represented in terms of English numerical system. So, this is nothing but 2 million. Okay, and interest on debt is here nil, and here there has been mistake. Always remember that it had to be 500,000. Instead they have given 5 lakh. So, note all these things. Okay, and cost of equity stands at 15% each. Cost of debt is 10% each. Now, you have to calculate the market value of equity, market value of debt, and market value of the firm for both Box Corporation and Cox Corporation. So, up until this we shall solve first. So, the first two situation is calculate the total value of Box and Cox, total market value. So, when you have to calculate the total market value, you shall get the total market value of equity and total market value of debt. But one thing here worth noting is that since interest for Box Corporation has been given nil, for Box Corporation there would be no any debt. And for Cox Corporation they have given interest, which simply means interest, the total value of interest could be calculated. The formula has been given in notation, if you have observed. Did anyone bother to see? The total value of debt can be found out by dividing the total value of interest from cost of debt or rate of debt. So, when you divide 500,000 from 0.10, you will be getting total value of debt. Okay, and the equity calculation is as same. Now, EBIT they have given specifically in the problem to be 2 million each. Now, for this particular problem, even though has been done, there has been some mistakes. So, I will give you enough time, please do take it down somewhere or anywhere. Okay. Now, EBIT they have given in the question, which stands at 2 million each for both Box Corporation and Cox Corporation. Now, to find out the value of the firm, we need net income available to equity shareholders. And to find out that from earnings before interest and tax, we will have to deduct both interest and tax. Now, this particular interest has been specifically mentioned in the question, which for Box Corporation they have given it to be nil, and for Cox Corporation they have directly given the value of the interest, which stands at 500,000 rupees. So, we have taken it directly. So, when you calculate the net income to equity shareholders would be standing at 2 million and 1.5 million for Box Corporation and Cox Corporation respectively. Since tax is assumed to be nil, the EBT itself becomes net income to equity shareholders. Now, once we know net income available for equity shareholders, and since they have given cost of equity or equity capitalization, or what we represent under KE, we can easily find out the total value of equity. Okay. So, it can be calculated by dividing net income from cost of equity. So, the net income available for equity shareholders for Box Corporation stands at 2 million. So, 2 million divided by 0.15 would give you 13,333,333.3. And for Cox Corporation, when we divide 1,500,000 by 0.5, we will get 10 million. Okay, and market value of the debt. Now, here this formula has been given in your notation. Please go back and find it. Okay, when they have given the interest amount and the cost of debt, this capital I represents total interest amount and KI represent total cost of debt. When we have two information, we can find out the market value of debt. Now, for Box Corporation, since the interest is nil, it simply means there is no any debt in the capital structure. And for Cox Corporation, since they have given, we can calculate at 500,000 divided by 0.10. Cost of debt stands at 10%. So, when you divide 0.10, you will be getting 5 lakh. 5 million. So, the total value of firm, this particular thing represents total value or your total market value of the firm. Now, since there is no any debt in Box Corporation, the total market value of equity itself becomes the total market value of the firm. But for Cox Corporation, there is both equity and debt. So, when you add the market value of both, you will get the total value of the firm. It is to be 15 million. Now, K naught is represented by EBIT divided by V. Okay. Now, EBIT is 2 million divided by total value would give the total cost of equity. See. Now, here you can cross check the answer or the formula. Since it is only equity, there is no any debt. the total cost of equity should itself become the cost of equity should itself become total cost of debt. You had total cost of equity to be 0.5% and total cost, overall cost of capital, you have got it to be 15%. So, does this formula stands to be true? So, K naught we can always find out by EBIT divided by V. And for Cox Corporation, it stands at 10%. Okay. Once after doing this, if anybody has any questions regarding it, please do not hesitate to ask. So, here one thing that has, yes, cost of debt and interest on debt. Okay. Yes, fine. Now, to be in most simple words, cost of debt is that part of expense that you will have to bear when you bring in capital in the form of debt. Okay. Now, when you represent it in form of percentage, we do tend to call it as cost of debt. We will always tell it to be 15% or 10%. Okay. Interest amount is the total value that you are going to pay, which we usually tend to tell it in terms of rupees. Okay. We might tell 100 rupees, 1000 rupees. So, to be very simple, that is the only difference. Whenever I tell interest, it would be in value, total value, or could it be 1000 shares and each share has an interest of rupees 100. That time you will have to multiply and get the value. Now, if at all interest is at 10%, it simply means the cost of debt is at 10%. Now, there is no any difference in terms of meaning for interest and cost of debt. But in terms when we specifically tell it in percentage or value of rupees, there would be some kind of difference. Okay? That's where the notations becomes important. I hope I justified your confusion. If not, do let me know. I can still make it easier for you. Okay. So, the next question was okay. Now, we have to find out the average cost of capital for each of the firm. That we have done. Now, even the average cost of capital for each of the firm we calculated. It stands at 15% and 10% each. Now, in the last they have given entire problem. When you work out, you will have to assume that it would be calculated under net income approach and there is no tax. Except for that, we have two different questions here. The first one is, what happens to the average cost of capital of Box Corporation if it employs 30 million of debt to finance a project that yields an operating income of 4 million. Yes. Now, this particular question we'll have to answer. That for Box Corporation, what happens when it brings in 30 millions of debt in its capital structure? They have said that it yields an operating income of 4 million. Okay. So, now let us consider only Box Corporation, because there would be no any confusion. We have already got net operating income to be 2 million. Okay. And because they have brought in debt, it will yield an operating income of 4 million. Now we can consider it to be two different. Okay. Whatever you consider, you just give a working note. So I have considered that already there was a net operating income of 2 lakh and it has been increased with an addition of 4 million. So now the EBIT stands at 6 million. Okay. Because EBIT is now. Just a second. Just check whether the voice is audible or not. Okay. Yes. See here, the EBIT, there has been addition of 4 million. So now the EBIT is standing at 6 million. But the one thing that we should remember is, here there was no any interest for the first particular situation. But with the addition of debt, it simply means that there would be some interest that has to be paid, and this particular thing you should never forget. Okay. Now yet again here they have not mentioned the rate of debt, or for that matter even the amount of interest they have not mentioned. So we can assume it, and when we assume, we should give working note. So we are again assuming it to be standing at 10% rate. Okay. So 30 million into 10% would come for 3 million. Okay. So because they have taken huge amount in the form of debt, the half of the earnings has been or had to be paid in the form of interest. So, this thing you will have to remember, which would be helpful for your net operating income approach. Okay. Now, if at all you wanted, you can also take into consideration other way where you will not add this 2 lakh EBIT, but whatever you do, you will have to give a working note. Now, your working note should match with what you have done, and what you have done should match with what the net income approach tells. Otherwise, the answer would be considered to be not correct. So, once after deducting interest, you will get the net income to be 3 million. Now, here there is a mistake. According to up until this point, what we have taken from that part, if we consider, here there has been a mistake. Can anyone tell what the mistake might be? It is as simple that the value of equity has been considered of the box corporation here in the problem what we had solved earlier, which stands at 13 million. But then, because we have considered the EBIT, the net income has changed. It is now 3 lakh. In the earlier it was 3 million. Earlier it was 2 million. That definitely cannot be the total market value of the equity. So, total market value would be NI divided by KE. So, 3 million divided by 8 stands at 0.15. You would get the total market value of equity to be 20 million. So, the total value of the firm would be 50 million. So, now this particular problem I solved maybe around 130. So, even after studying this for 4 years, if I can do mistake, definitely if you study before the day of exam, there would be some kind of mistakes. Okay. So, the total value of the firm stands at 50 million. So, K naught is nothing but EBIT, which stands at 6 million now. 6 million divided by 50 million would come around 12%. So, please do take down this problem and know the mistakes and try to understand where when we ourselves solve the mistakes can happen, and whenever you try putting zeros, be very careful. Follow only one kind which you will have to follow. So, when See here, one more analysis that you can do is, usually we tell debt decreases the cost of capital or overall cost of capital. Why? Because debt is a cheaper source of capital. Have we discussed this particular thing? Yes? That, like if you take into consideration the second problem, there we said because the debt portion increased, the cost of capital decreased and the value of the firm increased. Yes? But here see, you have employed 30 million of debt, but then the total cost, what has happened? Decreased or increased? Whether it is proper, because you increase the debt, the total cost of capital has decreased. See, it was 15% earlier. Yes, there was no debt in the capital structure, but now there is debt in the capital structure standing at 30 million. So, whether the total cost of capital has come down, decreased? Yes. But you should also remember that this can happen only up till certain extent. Okay. After that, the situation will start reversing. Now, why the situation reverse will be explained by NOI approach. Okay. Now, there is still more to the question. Now, I guess this was a 15 marks question if I am not wrong. Your last part question it was. The question looks very easy, right? When you just see the question, you will not know whether it is from capital structure, is it from your valuation of shares, whether it is from your dividend theory. You will have to know from which chapter it is, unless you know from where net income approach comes. Correct? Now, dividend theories, as the name tells, there are theories. Now, the persons who have given the capital structure theory has also given the dividend theory. So, all these things you will have to know. Okay? Now, the last part of the question tells what happens to the average cost of capital of Cox Corporation if it sells 10 million of additional equity to retire to retire 10 million of outstanding debt. Okay. But then for this particular thing, you can start solving, but the thing is that they have said that they are retiring 10 million outstanding debt, but the debt itself stands at 5 million. That is the problem. It is 500,000 the interest amount. So, to calculate the total value of debt, it is divided by 10%, which would give you only 5 million. Okay? And they have said that their 10 million of debt has been outstanding, which is not there at all. It simply means the question itself is wrong. That doesn't mean that you do not solve. You will have to give working note if you have to get the grace marks. Okay? The question is not wrong, that is the situation. You will have to tell it cannot be calculated because the debt itself stands at 5 million. 10 lakh of equity shares we can simply add. Okay, when you calculate, since you have calculated it to be this particular amount, you can simply add still more to this. But then to retire equity, the equity debt, it is only at 5 million. Okay, I will give you 2 minutes. In your own words, you have to take a note for that. Because all these years I have not at all solved this problem or the question paper problems. It was simply given for them. Since it is online classes, that is the only reason that I have given. Otherwise, I do solve, we only solve 2 problems. The rest, how much ever question it gets, it is your duty. If you need, you can solve. Otherwise, all is fine with the world. Yes, make working note. This problem requires too much of working note here. Starting from how do you calculate the debt amount to be, and after coming for your first situation, how did you consider the net operating income to be, and why did you consider interest, and how there has been a change. Coming to the last situation, why you cannot calculate it further. You can calculate up until finding the total market value of equity. Only the debt you cannot find out. Because debt also you can consider 5 lakh has been redeemed. But the rest 5 lakh, what will you do? Where will you keep it? Yes? That is the question. If anyone can come up with the solution, do let share in your class group. Yes. I hope net income approach was very much easier than you had thought of it. It was easy when we explained. It was easy when we saw the questions along with the answer. But it became difficult when the question was given and I myself had to find the answer for it. Yes. Now you can take okay. Up until this point, from chapter 3, we discussed regarding all the things under capital structure. What do we mean by capital structure? Now, why is it important for an organization, and what are the factors influence, and we started with the theories of capital structure. Now the first theory was regarding net income approach, which was given by Durant, and he said that the capital structure does have some effect on value of the firm, and when it is true, capital structure should be such a equation which can increase the total market value of the firm, and in that we show many things regarding how the portion of debt would have effect on the value of the firm. Now, the next approach is net operating income approach. But before going for net operating income approach, we will have to understand what is weighted average cost of capital. To what do we term WACC, or weighted average cost of capital? Now, it can come under capital budgeting decision also. And one more thing, your semester exam might be soon, so we have a lot of chapters to cover. So, anymore we cannot go in a slow speed. Okay, you will have 3 more practical chapters to be completed, and you will have to necessarily come to college with all the precautions to be taken. I hope you did get the information from the side of department. So, anymore it would be offline classes, and it would go on a very fast speed, whether you like it or not, whether you have a problem with that or whether you are okay with that. So, the situation is thus. Having said that, now regarding weighted average cost of capital, now the cost of capital simply tells the cost the firm has to bear when it takes up different sources of capital in its capital structure, or when it has taken different sources of capital to finance its organization. The cost of each type or each source of finance together is called as weighted average cost of capital. Now, in simple words, it can also be called as cost of capital. Why are we specifically mentioning weighted average? Now, whenever we tend to tell this particular word weight, here weight means the market value of each source of finance. Okay? Weight represents the market value of each source of finance. That is to tell, maybe in net approach we had observed the book value of equity shares were different and the market value of equity share was different. Whether that was the case? Yes, that happens because equity is traded in the market. So, there would be a difference. Okay? That's why debt usually does not change in its value, because it is being taken and paid off internally. Now, once again, this weight represents the market value of each source of finance. Now, having said that, what does cost represent? Average is nothing but a midway through two different things or many things. That gives the average every time. If it is 4, we divided it by 4. If it is 5, we divided it by 5. And it is a midway for everything together. Weight, you know, it is nothing but cost of sources of finance. So, what I mean, market value of each source of finance is weight. So, what does cost represent? Now, how did you assign that cost? That we said the expenses were 12%, right? Now, how did you tell that the expenses stands at 12%? Or when we taken debt, we said the cost of debt is 10%. How did that started standing at 10%? What does that 10% represents? See, you have equity, Equity's cost, we tell it as cost of equity or equity capitalization rate, and it stands at certain percent. That percentage definitely tells us if you take equity out of the entire equity, so much portion would be the expenses of that. But in actual, what does that represent? That particular part, or for that matter even in debt. Debt has cost of debt. The cost is for the company, right? But what does that percentage represent? That portion represents the return on investment expected by the investors. Correct? Equity would be invested by some outsiders in my company. Debt would be given to my company by a creditor. Yes? Now the cost would be the expense for the company which the company has to bear. But from investor point of view, is the return that he is expecting. His return becomes the expense for the company. Is that true? Is that what it means? So weight here represents the market value of each sources of fund, and cost represents the expected rate of return by investors. Investors they can also be those who have invested in equity of the company or even the debt of the company. Now what you can take down is weighted average cost of capital, take in minimum words as possible, is defined as weighted average cost of various sources of finance. Weight represents the market value of each source of finance. Moving to one more line, you can take the cost represents the rate of return or simply the return expected by the representative or by the respective investors. And while discussing this particular topic, it goes without telling that for that matter any organization it could be, okay, it can finance its capital structure by using different long term funds, okay, different sources in the sense it can be equity, preference, debentures, term loans and all other things we had discussed, and each of source of fund will have its own cost, yes, and each of the cost would be different. Now there would be difference in the cost of each source of funds because of the risk that is involved, and for each source of finance the investors perceive different rate of risk or the risk is perceived to be different. That's when there would be difference the cost of finance. That is to tell, the equity shareholders might be having very much faith in the firm. They will definitely have high rate of return. which they expect. Yes? And when it comes to debt, there might be a company on which the investors might have too much faith. Okay? And their main intention might be securing the principal amount. That time there are chances that they might consider a less rate of interest. Okay? Now these two are two different things when you equity and debt. But when you compare equity and debt together, definitely the rate of return expected for debt would be very less as compared to equity. Why it is done so, you will have to know. Why? Because the rate of debt is always lesser than the rate of equity. Why is it so? Because debt will always be backed by some kind of security in the company. Okay? The equity, when I equity shareholder invest in the company, I do not know whether I will get some kind of return. For that matter, whether the return would be continuous, fixed, or every year will I get or not. For that matter, if at all the company goes for a loss, then I will not even know whether I will get my principal amount back. But if at all the company earns very good amount of profit, there are chances then what I expect, then that I can get the return. Now that is why equity returns are more. Debt, what happens is you have invested safely. Okay? Now when it is debt, the company would having obligation to give you the interest, or for that matter, when it winds up, first the debt would be given out. Later on, if money is there, they go for the shares. Yes? That is why always the debt would be less. You can take into consideration the shares itself. Okay? The shares of some government companies and that of private. Government companies, it will always be, because there they give more preference for the security of principal amount. But with the private company, that would not be there. That is how usually it works. Coming back to your weighted average cost of capital, we were discussing why each different source of capital would have different costs. Yeah. Now when all these different costs, when we weight by their relative proportions to get overall cost of an organization, it is called as weighted average cost of capital. Okay, you can take down. A firm may procure long-term funds from various sources depending on their risk perceived So did I tell from various sources at different cost? Okay. Correct the sentence. A firm may procure various sources of long-term funds at different cost depending on the risk perceived by the investor. So when all the costs of different sources of funds are weighted by their relative proportion to get overall composite cost of capital. It is termed as weighted average cost of capital. Okay. Now, one more thing that we can understand here is regarding optimum capital structure, correct? Optimum capital structure said that it is such a equation of both debt and equity, wherein which cost of capital would be less, the market value of the company would be at its highest because the value of the company would be high. Okay. Having said that, the optimum capital structure, here it is assumed at a point where weighted average cost of capital is minimum for each of the project. Okay. And it is nothing but minimum rate of return from each of the project to pay off the expected return of the investors. Now, do not get confused. This is an information. Now, in our previous discussion, we said that the cost is nothing but what the investor expects. The same thing we are trying to tell. When it is optimum capital structure and we have calculated under weighted average cost of capital, it would be such a decision for which particular project the WACC comes to be the minimum, it would be considered as optimum capital structure. That is what this particular thing is, right? The theory until this point what we discussed, when you do it practically, it simply means among all the different situations for which the weight comes to be the least or the cost comes to be the least, you would be considering it. We had discussed it in the theory part with the example. Okay. Now, do not worry regarding this, there aren't any problems. The one which has been given in the earlier first one regarding calculate the cost, overall cost of capital, one problem, even before NI approach, that can be considered. Okay. Now, therefore, here we said working average cost of capital is the least of the capital. Okay. And it stands at a position of optimum capital structure. That's when we can tell that working average cost of capital is nothing but the required rate of rate. Okay. Now, required rate of return tells us what is the minimum amount that a company has to spend. Yes, that is represented by required rate of return. So, now regarding all these things we had discussed in our first chapter. That's why discussing first chapter for a month was necessary. Okay. Now, all these things we have already discussed. What is expected rate of return, what is cost of capital, cost of equity. Still the brain doesn't want to remember it. Okay, you can take it down. No, there is nothing to take down. So much if you know, it is enough. When you have weighted average cost of capital and you have optimum capital structure, it is such a position where the weighted average cost of capital would be least or minimum. and that minimum rate would be what the investor expect. That's where we can tell working average cost of capital is nothing but the required rate of return. Now all these things they would never ask anywhere, this particular weighted average cost of capital. But for understanding it is important. This thing will help you in analyzing the problem. The conclusion what you have to give requires this, or maybe your project requires this. Okay, your managerial accounting will require this information. Now, what information would be given in managerial accounting? I will not repeat it here once again. And whatever is necessary for strategic financial management from managerial accounting that has already been said, I wouldn't repeat it again, because the explanation of mine and other lecturers would definitely be different and it might lead to a confusion. So, we never tell, both of us will not tell, so that there are no any confusions. If I do, I go and share with your accounting lecturer, and if she does, she tells me. Fine? Yes. And you should always remember that whenever it is optimum capital structure or capital structure, yes, debt gives an advantage for decreasing the cost of capital, but then debt to be raised only up till that portion where working average cost of capital is minimum or least. Once it starts increasing, later on the debt should be not increased. Okay. Now we have different portions, right? When you keep on increasing up till a certain point, the WACC would come to a minimum. After a portion, it again starts raising. So it is said to what extent it is minimum, up till there you can increase the debt. After that, it is recommended not to increase. Now how or why it increases, we shall see in your NOI approach. Okay. Okay. Now this is all regarding your working average cost of capital. Now this might not be asked in specific, but you will have to know it. The next one is net operating income approach. The first one was net income approach, and now we have net operating income approach. Please do not forget the notation that has been given. The notations would be the same for this approach also. Now, net income approach was given by Duran, and even net operating income approach is also being given by Duran. Okay, but then the one feature of net operating income approach is that it is exactly opposite of net income approach, or in accounting words you can tell it is drastically opposite of net income approach, or what we in our common language we tell dead opposite, exact opposite. So if you know that, what does that mean? How is it exactly opposite of a net income approach? What does, for that to know, you will have to know what is net income approach tells. Net income approach tells that capital structure decisions are relevant for valuation of the firm. Yes, that it tells. When it changes, but it simply means the decisions regarding the capital structure you take is important when you value the firm. So if that is what NI approach tells, so NOI approach or net operating income approach should be telling exactly the opposite of that. Yes? So net operating income approach tells irrespective of what is the portion of debt and equity in your company, it is not going to have any effect on the value of the firm. Oh, now they are irritating, right? The same person, they give two different views. But then there is a reason why they do give such a approach. Okay? Now, whatever he had said under net income approach, we practically saw it and that did stand true, right? Did it? So, here under net operating income approach, Daran tells that, the value of the firm is nothing but it is independent of its capital structure, which simply means for a company it doesn't matter you have 60% of debt, 40% of equity, or whether you have 90% of debt, 10% of equity, or if you have 10% of debt and 90% of equity. All these things actually doesn't matter when you value the firm. Everything would be the same. So, cap structure decision need not to be taken. That is what NOI approach tells. In one word, if you have to tell, this approach, the capital structure decision of a firm is irrelevant. No matter how much you do consider, it is not going to have any kind of approach. Why? Because net operating income approach tells that the value of the firm is independent of capital structure. That is to tell, the value of the firm is not having any connection with the capital structure. Only then can it be irrelevant, right? Otherwise, it is not possible. So, since you know what is weighted average cost of capital, the NOI approach or net operating income approach, it tells irrespective of level of gearing. Level of gearing is what we are speaking, 10% of debt, 90% of equity. That is one type of gearing or one point. And when you change, it becomes levels of gearing. Okay? Gearing we had studied under notation, where we said regarding debt, where we spoke regarding the increasing of debt portion. Yes? Degree of leverage we spoke. Degree of leverage simply means there would be increase in the debt portion. So, the weighted average cost of capital tells that irrespective of the level of gearing, it will not have any effect on the capital structure decision or for that matter on the value of the firm. But why? How did that happen? Earlier this person itself he said, right? Earlier it was Durand himself who said the capital structure decisions are very much necessary. But why now there is difference of opinion here? What might have caused this difference of opinion? Okay. Now, you will have to be very much practical in knowing this particular point. Why Durand has said that? Okay. In practice, what happens is that the more and more debt you increase in the capital structure, the more return would be expected by equity shareholders. Why does that happen? No, I am increasing the debt, correct? Debt is from the debtor side. I mean, debt is from the creditors of our company. That is entirely different from the equity shares. Equity shareholders are the owners of the company. So, if I am increasing the debt, why do the equity shareholders tell that they need more return? What makes them to perceive that they need more return? Why? Why? Now that is what I said before we started off with this. What happens when debt increases more and more? You are obliged to pay something out of your profit. The more you pay out of your profit, the lesser the owners will have in their hands. Is it as simple as that? Yes? Now you have taken so much of debt. You will definitely have to pay at least the interest, and you are having the obligation of paying it on a fixed rate, on a continuous basis. Whereas dividend, is there necessary that you pay on a yearly basis? Is it fixed? Definitely no. So the more and more it goes in the form of expenses, the owners, they even have invested with the perception that they will earn more, right? So the more money goes out, they also want more money. Okay, because now if at all the situation is fine, everything goes on well, but then if something happens, the company would be unable to pay, or if there is any kind of loss, definitely it would be entirely anyhow lost the equity shareholders. But if the company would be unable to pay even the interest, or for that matter the principal amount of debt, the equities money would go for paying all these things. Dividend anyhow they would be losing, their principal amount also would be lost. That is why the more and more the debt portion increases in the organization, the equity shareholders start expecting more and more return. So when this happens, what happens is the advantage or the relative advantage that the organization had because of using cheaper source of fund, which is debt, would be offset by the expectation of equity shareholders. That is why Durant tells that actually taking a decision regarding the debt to be more, equity to be more, there is no relevance for that. Yes, debt would be advantageous, but the advantages would be equally offset by the expense of other source of fund. Now, this is what the NOI approach tells. The underlying assumption behind this approach is that the increase in the employment debt capital increases the expected rate of return by stockholders, and the benefit of using relatively cheaper debt funds is offset by the loss arising out of increase in cost of equity. Yes. Now it simply means that if there is any kind of change or in proportion to various sources of finance, simply cannot alter the weighted average cost of capital, and because of this the value of the firm tends to remain unaltered at all the all the time or at different leverage or different degree of leverage, because the advantage is one sources of fund would be offset by the expenses in the other. So now whether NOI approach is easy? See, you should not get confused. All the approaches are very much easy provided you understand the theory behind it. Okay? Now, whenever it is NI approach, when there are three different situations, there has to be change in overall cost of capital when you solve the problem. Okay? Because it is each level of gearing or degree of leverage would be different. That is why your capital structure decisions are relevant. NOI approach says it doesn't matter how much portion of debt you have, how much portion of equity you have. Everything would be one and the same, because the advantage in one sources of fund would be offset by the cost of other. That is all NI approach tells. That is how NI approach is different from NOI approach. Okay. Now remember what it has said and remember the assumptions. See, the change in proportion of various sources of finance cannot alter weighted average cost of capital, and as such the value of firms remain unaltered at all degree of leverages. See, now all this theory you will have to know. If at all for 15 marks question, they ask one question, one practical problem and one theory problem, and if you are unable to solve the practical ones, your theory will always be helpful. Okay? Do not skip theory in strategic financial management, because it is always 70:30. 70 portion would be definitely from theory. That's why we took so much of time. And 30% definitely would be from practical, but those 30% would be such questions, no matter how much textbook you go through, how many problems you do, what they would ask would be something different. And for solving that, you should have the base of theory. Only your theory can help in SFM. Now, moving forward with the assumptions. Now, with general assumptions, even you have assumptions for NOI approach. And remember one thing, irrespective of whether it is dividend theories or whether it is capital structure theories, each of the theories that has been proposed only stands true because of the assumptions that are underlying those theories. If there are no assumptions, what the theory tells would stand false. Okay? And the first assumption is that the overall cost of capital remains constant for all degree of debt equity mix, or what we call as for all degree of leverage. Okay. Now this is what we had explained regarding why does capital structure decision is irrelevant. Irrespective of what portion it is there, the advantage of one is offset by the expense of other. That is when under NI approach it is assumed that the overall cost of capital, or what we term to tell as K0, yes, that is that is going to remain constant or unchanged. Now, under the assumption, one thing we should know is that if at all the EBIT is given and if at all the cost of capital is given, we can find out the value of the firm. How do you calculate the value of the firm? If you know two, EBIT and cost of capital. See, overall cost of capital, how did you calculate? EBIT divided by V, value of the firm. So, if you know the value of the firm and EBIT, if you know the EBIT and cost of capital, how will you calculate the value of the firm? It is simple math, right? Value of the firm can be calculated if you have EBIT and cost of capital. In NI approach, what did you do? You had to find the cost of capital. Yes, overall cost of capital. You had the information of total value of the firm. You had the information of EBIT. So, you used to calculate K naught is equal to EBIT by V. Now, if you want to find the value of the V, do the reverse of that. Isn't it simple math? Yes. How it is simple math, I cannot explain once again. Okay. This particular thing, if you have taken down your assumptions, next to that, please do take down. V is equal to EBIT divided by K naught. Okay. Now, the next assumption is the market capitalizes the value of the firm as a whole and therefore, the split between debt and equity is not relevant. Now, this particular assumption is self-explanatory. It tells that when your organization is valued in the market, that is what matters, right? Whenever in practice, how your company would be valued in the market is all that it matters. Yes? And it tells that the market, when you value your organization, it is not going to make any discrimination or it is not going to find out how much portion of debt you have, how much portion of equity you have, add those two and value it. No, that is not how the market values. The market values the entire organization as a one whole. So, when that is the case, the split between or the discrimination between debt and equity will become irrelevant for the decision that are to be taken. So, that is the second assumption. And the third assumption is all regarding the essence of the net operating income approach. It tells that the use of debt having low cost increases the risk of equity shareholders. And when that happens, the equity shareholders they tend to increase their rate of return, and as a result there is an increase in equity capitalization rate. And because of this chain of reactions, the advantage of debt is offset by exactly increase in the equity capitalization rate. Now, the meaning of NOI approach itself is nothing but the assumptions of NOI approach. Okay. The first one, it tells that the overall cost of capital is constant for all degree of debt and equity mix. And the second one is that the market capitalizes the entire firm as one. So, we dividing it on the basis of debt and equity actually is irrelevant. And the third one, it tells that when debt is used more and more, it increases the risk for equity. When that happens, they tend to ask more in the form of return. It is nothing but what is called as equity capitalization rate. And as a result of all these things, the advantage of debt would be offset exactly to that point to where it it increases the equity capitalization rate. And the fourth assumption is, as usual, there is no any corporate tax. But what if in question they give corporate tax? What will you do? So, now there are chances that in exam they give corporate tax and they ask you to do NOI approach. So, we shall, once after finishing NOI approach, we shall see what can we do if they give tax. Because nowadays there can be nothing without the tax. Yes, you buy 1 rupees chocolate, you will have to pay tax. So, when there are companies which earns in lakhs and crores of thousands and millions, will you allow them to have all the profit? So, know the 4 assumptions. Yes. Now, after assumption, there is something called as presumption. Shall we continue today up till 4:30? No, if at all the situation is that we have to finish in 15 days, I have taken before up until 5, I can extend till 5:30. And your super seniors, they used to have classes up until 6 also. Not from my side, but the history of the college is such that the classes would be taken in a stretch from maybe 2 to 6, 6:30. It depends. Okay. Until how much of portion of energy I have in me, I shall continue. See, one more thing, it all depends upon you. Now, whatever has been discussed, if you go and read it once again, you come back and sit, after understanding it, we can easily go forward. The more you show that you have not understood, the more time it takes to explain. So, your effort is very much necessary in you yourself, resulting in whether I have to take more class or whether I have to take less